Alright, good afternoon everybody. Should be live on both YouTube and the virtual trading floor like usual. Somebody say hello so I know I'm alive. Thank you, thank you, thank you. Alright, let's do it. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure, I am not in NVIDIA. Sorry, I forgot to take that off. I'll just repeat that so everyone has it. I am not in NVIDIA. It gets a big X. A big X. Matter of fact, I'll just do that real quick. There we go. I am not in NVIDIA, but I am in Neo. It's a new position. Cool. Let's go over to the charts. There I am. Wow. Wow. SPY is 3%. Like you don't see that 3 number too often in the marketplace for the S&P, especially on the upside. 3% for the S&P, 3.1% for the Qs, 3.8% for the IWM. Just an incredible squeeze. Look, we had a breakaway gap today. We talked about it in the morning meeting. This tail on my chart is fake. I don't know why this tail is here. This is a breakaway gap. We discussed the possibilities of what the market could do today, the potential of a short squeeze or sideways digestion, or the fact that we're in a bear market so they could sell us back down. But I definitely made sure to discuss the potential of a breakaway gap and briefly what that is in the morning meeting today. So a breakaway gap is basically when when the market gaps above resistance or below support. Most of you probably have access to my training program. You can review my gap class. The breakaway gaps are important to have an understanding of, because as opposed to a common gap or an area gap, which is the typical gap that we see on most days, breakaway gaps tend to not get filled. Common gaps tend to get filled. Breakaway gaps tend to not get filled. Why? Why do they tend to not get filled? Because of market dynamics. So think about this, right? Try to block out today or even yesterday from your chart, right? Going into yesterday morning, we had this terrible looking pattern. We've discussed that there was some potential support around this 360 to 365 area from back here with these June lows. But with that said, with that potential double bottoming type support that was there, we are downtrending on multiple time frames here, from your very big time frame to your intermediate time frame to your small time frame. Last week, while I was on vacation, we just broke down atrociously, and then we spent a lot of last week basically bear flagging. If you go back to September 23rd, the market here got very extended to the downside, especially at lows. At lows on the 23rd, your SPY was trading at almost 363. with the ADMA at 381. So we had that $17, $18 worth of extension from the ADMA that I begin to classify as really extreme. Generally, just as a very general rule, when the market starts to get $10 plus away from the ADMA on the upside or the downside, that becomes very notable, and usually you don't want to be chasing at those prices even for momentum. But the long is always a little bit tricky. We never want to catch a falling knife. But once you start getting $15, $20 extended from the ADMA, I've never really seen that be able to last without time or price correction. And then, as bearish as you could possibly be, what this market does from $18 of extension is go sideways for 3 days, with a little bit of price correction on that day 3 to the upside to kind of get back to more or less resistance right as the ADMA is finally beginning to catch up. And then what you have here is the beginnings of a bear flag. The beginning of a bear flag. And then day 4 is pretty much another rest day, letting those moving averages catch up a little bit further. And day 5 was a breakdown day. So this now is Friday of last week. the last day of an atrocious month, the last day of the quarter, higher volume breakdown of this bear flag pattern, downtrend continuation. I mean, this market could not have looked worse. You know, this sideways time correction here is about as bearish as you can get. That creates this bear flag, followed by actual continuation on Friday to close at lows on high volume. Month ends. Coming to October. I still can't get over that quote from Shane's link this morning that he kindly provides to us each day. Buy in October and go sober. Really funny. We get a little bit of a snapback day yesterday. It was a strong day on a percentage basis, but that was after the market had gotten destroyed. All it did was bring us back to the ADMA. It was not yet a failure of the bear market, but it was of the bear flag. But it was notable that we didn't get further bear flag continuation. But you only really get a failure of the bear flag if you start breaking above the resistance of the bear flag, and particularly the highest point of that bear flag. And that's what happened today. And it happened via a gap. So we had a gap above resistance. And what that does is any person that is short from any of this time or liquidated their longs, but particularly those who are short, which is probably a lot of people on the continuation of this bear flag here on Friday, or a lot of people who are short in this pattern here, all of those people are then out of the money. So all this volume that we had in here, particularly with this volume culminating on this Friday, 1, 2, 3, 4, 5 days, 6 days of price action down here, all of a sudden, or 7 even if you want to include yesterday, all of a sudden anyone who's a short seller on any of these 7 days worth of price action, if they're using a stop loss that is that resistance, which is standard technicals here, if they're using a stop loss as resistance, the market gaps up above resistance, all of those people are screwed. And if you're short and you're screwed and you're losing money, you're getting squeezed. And that is buying, right? Or the flip side is, if you were liquidating your long positions into this down move, if you liquidated your long positions on Friday last week, you threw in the towel, oh my God, this bear market continuation of this downtrend. And now all of a sudden we're getting back above 370. You go, oh my gosh, I can't believe I liquidated my positions. And if you're undisciplined, maybe you're chasing back in. So those are the supply and demand dynamics that enable a breakaway gap, which is a gap above resistance, or you could have breakaway gaps to the downside, which is a gap below support. Those are the market dynamics that tend to create breakaway gaps to be a gap and go. You have a little bit of a lower probability of a breakaway gap to the upside given continuation in a downtrending market. So I was certainly a bit nervous this morning. Breakaway gap to the upside potentially, but it is still overall a downtrending market, and it's after we had a really strong percentage day yesterday, and the gap up this morning was so large also. So I forget exactly what we were up yesterday, but I think it was like 2 point something percent, coupled with like a 2% gap up this morning. I'm looking at us up 4% in like a day in the morning in a downtrending market. I still think. And I have no regrets about the fact that I was selling some of my long positions at the 372, 372.50 SPY equivalent this morning, and now we're $5 above that. I have no regrets for following my game plan for trimming and trailing even after we continued, and that's part of trading, right? You can't have regrets if the market continues. You can't have the psychology of saying, oh, hey, if I didn't sell any of my positions, I would have made this amount of money more. That's not the right way to think. You create a game plan for yourself, you follow your game plan. The other portion of my game plan, though, is the holding part, which we've discussed, many, many times here as a team. If you caught any of those longs, particularly any of those longs from yesterday, and you still have them by the close. I remember, as an example, we were talking about Apple, that buy around 140 yesterday, and that I know a bunch of people took it. A bunch of people were on Google yesterday also. If you have any of those, if you have that Apple 140, it closes at 142.50. You have a $2.50 profit cushion. You keep that position overnight because you're in a win-win situation. Because why not? And then you continue to trim and trail. If it wants to give you the move, let it pay you. I mean, for me personally, I've made, really the better portion of my year this year in 2 moves, and they're in up moves, even though it's a bear market. Because, you know, being honest with you guys, and we've had this honest discussion in the past, I am a better trader to the long side than I am to the short side. Does not mean I'm afraid to trade to the short side. I absolutely will do it. I'm just better at holding my winners to the long side and probably being disciplined with my game plan. But for myself, even though it's been a bear market, this March move and this July-August move were massive P&L periods for me throughout the year. Is this 2-day move going to lead to another move like what we had in March, or another move like we had in July-August? I don't know. Probably not, to be honest. If we want to talk about probabilities, and that's the game that we're in, probably not. But even if it's a lower probability situation, I don't know. How low of a probability of a situation is it that this market works its way back to $400? It's not very high. But I'm in that win-win situation now with some of the positions that have been put on. I was probably very fortunate, to be honest, to be on vacation in September for some of this down move, and kind of came back, more or less just at the right time. But if we continue to get that up move, I'm going to continue to follow the game plan to implement trailing strategies for reward maximization to really make sure that I get paid. And thank you, Rich. And that kind of goes back to a little bit of what we were talking about yesterday also, when I was speaking to you guys more broadly about the money management aspect of this business really being the key to success. That you just quite simply have to be involved in the math game here, which is to enable yourself to make more money than you lose. So the way that you do that is by keeping the downside limited, and Millerbot, you keep the downside limited, and you put yourself in the position to make P&L on the upside that is that's a multiple of what you can actually lose on the downside. So you got to be able to learn to hold those winners. Again, just going back to the Apple that I was just referencing, if you had Apple at 140 yesterday and it closed at 142.50, it's a great trade. Nothing wrong with booking a little bit of profit into the close and just putting some in your pocket. But I don't like the idea of fully liquidating that position. I want to say, hey, I could have a target number 1 on just an oversold bounce of the 80 MA back to 146, where you know what, I've sold 75% of my position. I'm gonna make money in this thing no matter what. It's a big picture counter trend trade, and on this other 25% of my position, it's worth it from a risk reward perspective to give it back, potentially even all of this move back to 140. In case I get a move up to the 80 MA here, which could be target number 1. In case I get a move up to the 21 EMA here, which could be target number 2. It is not outside the realm of possibility for Apple over the course of this week, next week, to be revisiting 150, 151. And now next thing you know, you're in this trade with 25 cents risk, 40 cents risk, I forget exactly what it was, and you're making $10, $11 on the upside. Those are lower probability outlier moves, but the way that we put ourselves in the position to make bigger risk reward on lower probability moves is by being greedy after we're already in that win-win situation, when we have a good profit cushion, so that there's no, I don't want to say there's no risk in keeping an overnight position. There is always risk in keeping a position overnight. You never know what news can happen, but you've got significantly. You just have a profit cushion that helps negate the risk of an overnight gap against you. So that's kind of a lot of what we're looking for. I do think that the buys today, bigger picture, were a little bit tricky just because of the degree of the gap, but we certainly talked about the potential for short squeeze, and you could pretty much see it right off the open, especially with what was moving first and what was moving fastest. A lot of the names off the open that were moving hardest and fastest were those short squeezy type stocks. They were those growth names that are just super beaten up. Looking at like remember off the open, looking at Shopify and going, oh wow, they're really squeezing this thing, and looking at Path, and this Path kind of faltered a little bit, but off the open, oh wow, they're really squeezing it. Looking at Snap the first 10 minutes, like this is all classic short squeeze stuff here. If we're having this degree of a gap up that then is followed by 2 upside Maribozu candlesticks. And then the real question, and I mentioned this in the morning meeting, like if we get that short squeeze, is then what happens. Because we have certainly seen over the course of this calendar year on certain days where you would get that opening upside momentum to the long side in some of those growth stocks, and then by 10 a.m. they're breaking lows. And it was just like a quick little short squeeze type of event, a quick little momentum type of event. There's no true buying that comes in the market, and then you're rolling all the way back down. So the real signal for me, because I'm not personally going after. I'm not going after, and the SPY's never even really rested. I'm not going after this move here. I'm just not. The gap here is just too big. I know it's the potential of a breakaway gap. I know breakaway gaps can lead to these short squeezes, and it's just not my type of trade personally. There is, for pure momentum scalpers, there is opportunity to make money, recognizing that short squeeze, recognizing that breakaway gap. Buying these SPYs here early in the day, buying that snap early in the day, buying that chop early in the day, and really kind of participating in that squeeze. The setups that I'm more looking for are, all right, after a 10 to 15 minute short squeeze, which that's usually about how long it lasts, what's the setup that actually comes in that could be more of a real setup? Do we just plummet all the way back down, give 100% plus retracement, make new lows on the day for some of these stocks? We've seen that happen already in this calendar year, in this bear market year that we've been in. And then that was just it. It was just a quick squeeze. They got out of the way. They bought the top, and now the market's actually kind of continuing its downtrend. Or do we then get a real setup? And a real setup has to come in through some sort of price or time correction. And SHOP just happens to be the one that I have up right now. SHOP was particularly strong. The SHOP price corrections were like hardly even price corrections, like this pivot here at 940, not even close to the ADMA. This pivot here at 955, really not even to the ADMA. And it's just obviously a 5-minute chart. You didn't even get a test of the ADMA in SHOP, which again was one of the strongest of the strong ones, 13.5% on the day. You didn't even get a test of the ADMA on the 5-minute until 10:30. That's kind of incredible. But if you were looking at more of these FANG names, this is really what I was looking at for the actual setup, was the Amazon kind of bull flag that came in, and we were discussing this Amazon bull flag in real time. Or Apple, we were talking about this Apple pattern, and I know this was tricky here. Eventually the lows broke, but this is the type of pattern. I love this type of pattern. And the flip side that you could point to is the fact that Apple gave an opening consolidation when the market gave continuation actually means that Apple was showing some relative weakness here. I would prefer this Apple trade, and I know a bunch of you guys took it. I would prefer this Apple trade if Apple was also doing what the market was doing. So you got the SPYs here, you got the Qs just giving straight continuation. At the same time, Apple's going straight sideways. I normally actually really like this pattern. And we discussed this in the morning meeting also as a potential for the market to do this. Where you get the gap up, you get sideways action for 30 minutes, the ADMA catches up. This is a bull flag. This is a bull flag where the flagpole is the gap itself. Bull flags tend to give continuation when the ADMA catches up. The gap is so big it takes 30 minutes for the ADMA to catch up. I particularly love when this pattern ends with an inside bar because we can use that for tighter execution setup. Not only did this end with an inside bar, it ended with 2 inside bars, so we call that a 5-minute shooter. So that tightens the risk up even further on this trade. Then you can look for this inside 5 and up basically on this continuation, this momentum trade. Again, I know a few of you guys took it. It was pretty good immediate follow through. Again, a little bit of weakness. The one thing that I didn't like about this Apple though, whereas I normally love this pattern on a breakaway gap type of situation, market's gapping above resistance. What I didn't love here is that in this case it was actually relative weakness. Because again, you look at what the SPYs are doing, they're going vertical here. You look at what the Qs are doing, going straight up, and you look at Apple going sideways. So that would actually be a layer of probability against the Apple long trade that I know some of you guys were involved in, is again that flag continuation shouldn't be building out that flag because the market's not building out it. I hope I'm saying that right and it makes sense. But that's generally what I was looking at. This Amazon flag pattern. This showed a little bit more strength along with the market, right? Because had that big opening move, a couple bars of rest, and then setting up for continuation. Google, I know I called out a Google long, I think, versus this low as it was coming in, even though that pullback was a little bit deeper than I would like. It still kind of gave the opening momentum. This one struggled with the new highs. Microsoft was solid. I missed this one. I think it was communicated here through the team. You guys were communicating Microsoft. Still is my favorite stock in the stock market. You know, great opening strength here along with the market. This really tight inside 5. This is a momentum trade though. You know, EDMA is not even caught up to lows yet, but that inside 5 and up off that relative strength here in Microsoft was phenomenal. But those are more of the patterns I'm looking for in this gap. I'm trying to be this big of a gap, even though it has short squeeze potential. I'm actually more in profit-taking mode into that still because I've already got longs on. And then for actual new positions coming in, I want to see what the setup actually looks like when it comes in, recognizing that that setup, it might take, you know, 20, 30, maybe even 45 minutes for that EDMA on a small time frame to catch up to lows, or, you know, catch up to the base of the pattern that like Apple was putting in that can actually give me more of a real setup. I struggle for a word. I don't the right word. I don't want to say that, you know, a momentum setup is not a setup. A momentum trade is not a trade. Of course it is. It's just a different type of trade. When I'm saying a real trade, I don't mean that those are fake trades. They're very real trades. I just mean when you're doing the momentum trades, my issue with them always is that I find that it can be very easy to get shaken out of the trade, and then the trade still works. So your idea was right, but you lose money on it. That's something that I know, and this is where, you know, you need to know yourself as a trader. You need to know what works for you as a trader. I know for myself personally, I really struggle with that. I really struggle if I get stopped out of a position and I don't know that the idea was wrong. That's when I personally, knowing myself, I tend to fight stock. Fighting stock is not good. It tends to lead to compounded losses. So that's why I look for the setups kind of the way that I do. I'm not saying it's wrong to be going after any of those momentum short squeezes off the open, because they were certainly there and you could make money in it. It just tends to not be what you know, personally, you know, kind of particularly looking for. So some great setups in the FANG names, you know, kind of came in for us. You know, still a shout out to Cody on the Neo pullback, because we had discussed Neo in the morning meeting. One of you guys brought this up as a potential long versus yesterday's high, which is 1594 for an inside day and up for a snapback into this equilibrium. So 1594 is yesterday's high. Get an opening pullback to 1595, so it holds it perfect. It creates this pivot, a little bit of a price correction there, and then we get the upside continuation. So that was a good trade. And if you missed it where I bought, you know, I was buying like just above $16. It gave you like this other little inside 5 for, you know, kind of some momentum to be able to come in. So that was a good trade. You know, shout out to Cody for putting that one on my radar, because I would not have made money otherwise. With that said, honestly, as I look back at this Neo in hindsight, there is one thing here that I don't love about it, which I can say this with a little bit of a grain of salt because it's a Chinese company. So we know that with the Chinese companies, they tend to have a little bit of a lower correlation than, you know, Neo's going to trade at a lower correlation to the SPYs or Qs typically than like Apple will, obviously. You know, just because it's a Chinese company, whatever, a little bit of a smaller, you know, market cap obviously than Apple. I was actually trying to avoid names that were selling off the open. Because I know that a few of you guys were looking at Netflix, and the point that I was trying to make with this Netflix, similar to what I was just talking about with Apple. You know, how Apple I was just discussing. I love this pattern here with Apple, but you can't just look at Apple in a vacuum. You got to look at Apple along with what the market is doing, with what other stocks are doing. And even though I love this pattern in Apple, I think it's a very bullish way to digest a gap, and it's a great long setup that kind of comes in on this break higher. You have to recognize that the reason why Apple was forming the setup that it was because there was a degree of relative weakness there. If you go back to Netflix, looking at Netflix in a vacuum, I like this setup here. You know, fine, it gaps up really big, but it pulls back into equilibrium. It gives me this hammer candlestick off of, you know, my moving averages here after filling part of the gap, closes that candle well. I would normally really like this setup. And then it gives an inside 5 after that, so potential of an inside 5 and up. But the reason why I was kind of downing the Netflix long a little bit today was because why is Netflix giving me this first 5-minute candle when the Qs are doing this in the beginning of the day? So similarly to how Apple here, I normally would really love this setup. I gotta view the fact that it's not doing what the market's doing, that it's acting weaker to the market on an intraday basis, a layer of probability against it. It's the same thing here with this Netflix. I like the Apple setup, like that bull flag setup better than I like a technical pullback hammer into equilibrium setup. Little bit different. I think that the Apple setup is a little bit stronger, but this is still a trade that, if the market was doing the exact same thing, if the Qs gapped up really big, gave me a strong negative Maribozu, gave me, this was one of the other setups we discussed even for the market, right? SPYs gap up really big, they hit it real fast for, 5 to 10 minutes off the open, and then we're, with a tail, like almost retesting that key 370 level, holding 370, snapping back up and giving a hammer. That was one of the scenarios that I was trying to get across to you guys in the morning meeting that we could see, because we are in a bear market. 370 is a key level. We could sell real quick for 7 to 12 minutes right off the open, hold the 370 area as those moving averages are catching up, so it's more of a price correction than a time correction. That hammer comes in and you look for the buy. That's exactly what this setup is in Netflix. Normally I would really like this if the market was doing the same thing, but the market wasn't. The market's shooting higher. Netflix is giving me a big fat red bar in the beginning of the day. You got to ask yourself the why on the relative weakness. And I know Netflix, I think, was on my spreadsheet for this morning as one of the names that's on my list, particularly looking for a breakout of 247. And the reason why Netflix is on the radar at all is because this Netflix has shown tremendous relative strength for the entire month of September. Look at the daily chart here of Netflix. Go look at the daily chart of your SPYs and Qs for September. You're seeing tremendous relative strength. This thing is set up beautifully. A lot of people probably have eyeballs on this thing. If this was doing what the market was doing, if this thing opened up at 245 and was doing what the market was doing, you could have had a quick run up to 247, then maybe it consolidates like what Amazon did. Maybe you get a 15-minute consolidation right in front of the daily level breakout of 247, which is the spot that we were talking about. Like, oh my God, that setup would be fantastic if the market's doing what it's doing, if Amazon is doing what it's doing, and Netflix is right alongside of them, equally with equal strength to the market. You're getting that bull flag set up right in front of 247. That would be something that would get me really excited. It was totally on my radar today, but it never cleared 247. It's relatively weak off the open, and even though I like this pattern, it's the same issue that Apple had, but only worse. Why was Apple relatively weak? Why was Netflix relatively weak? And again, it doesn't mean you can't take the trade. You just have to recognize that's going to be a layer of probability that is against the trade. And even same thing with Apple. I like the Apple trade even better than the Netflix setup, because at least this one was going sideways. But you still have to recognize that the fact that the market's going straight up and Apple is just digesting here going sideways is a layer of probability against it. Another layer of probability against the Apple trade was just the chart on the daily, the location on the daily chart. And this thing's gapping up to the ADMA here. It's been one of the weaker names over. It was the strongest name in June, July, August in that bounce back. But more recently here, right, we saw some headlines come out about a slowdown of iPhone sales or something like that. For whatever reason you want to stamp on it, this thing has been weaker here recently, playing some catch up to the downside on the market. So I think that's it. I think that's pretty much all I have. Just really wanted to kind of re-review with the gift of hindsight here the game plan that we had developed in the morning meeting, why we discussed the possibilities of what the market could do today, what a breakaway gap actually means, some of the setups that actually came in after 15 to 30 minutes. Those are the setups that I tend to like a little bit more, because now the market, if you're getting continuation post, generally if you're getting continuation post 10 a.m., it's no longer just a short squeeze anymore. And especially if you're getting continuation post 10:30, it's no longer a short squeeze. The fact that, I know that most of the move was in the beginning of the day, but the fact that this market basically held up was fantastic. And I'll tell you what else. This pullback here midday, I remember watching this, between like 12:30 and 1:30 today. The fact that we recovered from this pullback to close at highs that's a really positive sign. You know, this market easily, if everybody's caught wrong-sided, and we know a lot of people are wrong-sided for this move, if everybody's caught wrong-sided, you get this opening squeeze for 30 minutes. You go sideways here for a couple hours. You know, there's still some buying coming into the markets, still some people kind of, you know, working out of short positions, whatever it is. Finally, that's done, and the rollover comes in. This is where the bears should be pressing it, right? And the fact that we began this rollover here, and I was even envisioning it in my head, I'm sure you could all see it. We've all seen it in the past. This rollover comes in. Usually it's going to be a little bit more close to the close, but this rollover comes in. Next thing you know, we're retesting lows. Next thing you know, we're breaking lows. And I could have been I could be doing an afternoon meeting very easily with a mixed type of signal where we close above 370 still, but it's like a upside tail red candle closing at lows above 370, where it looks like we're setting up just to break back down, and they squeezed everybody who was short in this bear flag type pattern on the daily chart, and now, you know, we closed week at, you know, just above 370, and we're set up to gap down, you know, below it again tomorrow. And that's not what happened. So, you know, there's still some bullish things to look at here. That IWM relative strength that we've been pointing to, the fact that we were able to close at highs, the fact that we were able to cover that midday sell-off, all that's really bullish. But with that said, after such a big two-day move here, I'm sure our short-term sentiment indicator is going to be cooked to the upside. We're approaching the 21 EMA. We hit our target. You know, I was talking of an upside target here at the end of last week and beginning of this week of a break higher into the upper 370s to 380. You know, we didn't quite get to 380, but we're certainly in these upper 370s. So we hit our target. So I think at this point, what you want to see, whether you're a bull or a bear, is I think that you need the market to build out a new setup for you. So most likely, and obviously we'll see how we gap tomorrow, most likely I will once again not be looking to be aggressive tomorrow. I'm going to want to see how a market kind of resets itself up. If you are thinking that this market could give upside, you know, further upside, which from a market dynamic perspective, it certainly could, but you're not already long, I cannot support coming in and buying, you know, 378 to 380 SPY or SPY equivalent in individual stocks tomorrow on day 3. I cannot support that. If you're looking for any sort of upside continuation, you need a new setup to come in. And if you want the bear setup, a bear setup for tomorrow could be a gap up. We gap up again. We have a decent sized gap up. We gap up a couple bucks tomorrow. We gap up into like 380 tomorrow. You could probably look to short that for like an initial trade and then see on the gap fill how the market handles itself from that point. If we get a gap down tomorrow, I think that's going to be the worst for everybody. That's not a short setup if we gap down tomorrow. And from a long perspective, I think it's too early to think you can come in and buy that dip without having a new setup come in. So you know, again, just let's see how we gap tomorrow. But broadly, like a flat to down open is going to be very difficult with nothing to do. You get a solid gap up, then you have your profit taking that can come in for any longs that you still have, and a potential short setup, which is just a day 3 gap up into resistance. So that's all I've got for you guys. Yeah, I'm seeing that there's some questions, but I'm also seeing Mark's comment here out of the corner of my eye, and I want to mention Mark's comment because I was looking at that also. Mark here saying, I wonder if the United Nations comments regarding the Fed is causing additional pressure. If the drumbeat gets louder, I wonder if that could cause the Fed to maybe back off 75 basis point hike in November. Just something I'm keeping on the radar that could ignite a rally. 100%. And that, you know, maybe I should work for the UN. That's exactly what I was trying to get across to you guys, like yesterday morning and yesterday afternoon. You know, the big threat to me on this market is becoming less the Fed and less inflation. The big threat to me on this market is the Fed overdoing things, the degree to which that's going to hamper earnings in these next probably 2 earnings seasons that we're going to come into. I think that if this market is really continuing to see lower prices, it's because earnings are falling apart. Recession negatively impacting earnings, and the E of the PE multiple causing prices to go down. Not the multiple itself at this point, but the actual earnings coming in. And then the other portion of it is the degree to which, we kind of break the world here a little bit, which we've already seen that a little bit with, what the yen is doing, what the euro is doing, what the pound just did, the fact that the British central bank basically just had to come in and announce emergency long end gilt buying for to kind of save the pensions over there. That's the thing that we're really, I think, having to weigh here, because the flip side is the Fed listens to the UN a little bit, they listen to me a little bit, which I think makes logical sense. They point, and they've gotten out to be able to do this. You point to the commodity data. You point to what I've been saying the last couple of days. Lumber prices are up 70%. That a lot of that is already there. The warning that's come out of Nike, the warning that's come out of Target, the warning that's come out of Walmart. And they can easily say, inflation is a little bit backward looking. A lot of the metrics that we're looking at are showing inflation actually coming down, and there are certain metrics to the inflation number that are lagging. Like the rent number is always going to be lagging. I think that's 7% of the CPI, and that isn't going to show immediate improvement, but we're seeing improvement in these other areas. We want to see what all of the hiking that we've done actually does to the economy. We're going to take a little bit of a pause here, and we're going to do a 25, 50 basis point hike instead of a 70 point hike, and then then for the the next meeting after that, we're considering just kind of doing nothing and going into wait and see mode. And if you do that, again, it's this fine line of is it early enough for them to actually do that before breaking anything. The problem that the Fed isn't going to want to see is probably how big the market's going to freaking rip off that, right? Because everyone's going to go, Fed pivot, market's going to rip, and we know, once again, and this is what's so key to understanding the March rally, the July to August rally, incredibly quickly, those same market dynamics that created those other two bear market rallies that were massive this year, that July-August rally was massive, those same market dynamics are already back in play again here, where everybody's hedged, everybody's short, and then that becomes the conundrum that the Fed's going to have to deal with, because then, how are they really pulling back on inflation if you got the S&P, back at 4,300? It just becomes really difficult unless we're seeing it come down in the other areas, right? Like I keep saying, these 7% mortgage rates. I've got I got a buddy from town here in Long Island who is a police officer, and it's just his timing on life, where he is, looking at buying a house right now, and I'm just like, oh man, you're gonna get locked in on this 7% mortgage rate. I'm sure you'll be able to, refinance that if rates come down, but it's like you're gonna be buying a $300,000 house, and you're gonna be spending the exact same amount on a monthly basis as somebody who just bought a $700,000 house a year ago. And there are some people who are going to be in a situation like my buddy, or maybe like Sharir here, who they don't really have a choice, and it's just going to have to happen, and they're going to have to do it anyway. But there's going to be a lot of other people that are out there that are just going to be like, no, I'm not. Either I'm not doing it, or I just straight up can't afford it. And I think that you almost have to see these housing prices come down. But we're in this spot right now where the housing prices haven't really come down too much, but you still get a 7% rate on it. It's going to be interesting. I know I missed some questions, but let me just go to PS's comment. Even if the Fed pauses, they're not cutting. Yeah, I agree. They're not cutting. And even if the Fed pauses, they're not. And that could be another thing that they point to, right? We're going to pause. We're not going to cut, but we're still going to continue our quantitative tightening, right? Because there's still, rolling off on the balance sheet. So they can point to that, and I think that that's fine. I think that's what they should do personally. So you're maintaining a level of tightening. That you're still working towards bringing inflation down. You're not going back to buying bonds. You're not going back to quantitative easing, but you're just taking a pause on things. But I still think that with market dynamics where they are, them even saying we're slowing down on the degree to which we are increasing interest rates or pausing entirely, I still think that is enough with where market dynamics are. If you got to start unwinding the massive amount of puts in this market that we've seen that data on, the shorts that are out there, all the cash that is kind of been sitting on the sidelines, and you have to couple that with the fact of low liquidity. We're in a really, really low liquidity market environment. I personally, in my career, have never seen liquidity as low as we've seen for the year 2022. It could just fire off a repeat of March, July, August, and you really could have a possibility of seeing us back at 410, 420 in the SPYs just off of that. And I'm not saying that has to be sustained, right? The big thing that we pointed to on both the March rally and the July-August data, and this is just data, is that this was never really new buying coming in. Maybe some of it a little bit towards the end. This was primarily exactly what I'm talking about, just the rolling off of hedges and the rolling off of shorts in a low liquidity environment. And you could just see that. And that could rip us back to 430, and we create a pivot point back there, and we work our way back, and we stay in these 400s. One of the things that I have mentioned in the past, though I haven't said in a while, is just because an event like that happens, I'm never going to be sitting here and calling out new highs right now. I think that seeing new all-time highs for this market in the year 2022, which we don't have much time left, is extremely low probability. Even for most of 2023 is probably low probability. But there's a real situation of a sideways volatility environment, which could be the Fed indicates that they're pausing. We rip all the way again, another one of these short squeeze rallies. We come in an earnings season. Earnings are garbage because of what they've already done. Brings this market, back down, but then you've got a balance between the fact that earnings are pulling back and the fact that the market is viewing the Fed as kind of relaxing a little bit, and you get, a broader, sideways yet still volatile environment. I personally wouldn't mind that. So let me scroll back up here because I know I skipped at least a couple of questions. First I think I'm seeing here is from Chinggis. What do you think of a short trade of an inside 15 on the SPYs and Qs at 11:15 on Friday of last week? I don't mind the question because I know we don't do an afternoon meeting on Fridays. So Friday of last week, that was in here. You're asking me about an inside 15 at 11:15 that day. Man, I wish I still remember the context of what was going on into that move. So we rallied up to like 366 in the SPYs. This 5-minute chart. Was that rally kind of failure on Friday? Friday was this day. Let me read the rest of your question. Qs and SPYs are weaker than the IWM, which I don't like for a short. IWM also has put in a shooting star at really high volume, almost filling the gap. Oh wow, that's here. Yeah, I like that. I like that piece of information. Even though the Qs and the SPYs did not, the price was extended on the 15 and 5-minute charts. But the market, the SPY, was above 264.85. Identified in the morning meeting, which was not on my side as well. Okay, so yeah, no problem. I wish I remembered the more specifics of the context on Friday better than I actually do to give you better feedback. Just kind of, Just being totally open with you, I was still playing a lot of catch up from vacation on Thursday, Friday. I like a lot of the things that you're saying here. So first of all, you got a bearish market. You are recognizing the Q SPY relative weakness, so you're focused on shorting that with an inside 15 as you're seeing an upside extended 15-minute shooting star come in to the IWM. I like everything that you're telling me here. I don't love the time of day broadly, and I don't want to give too much feedback because I honestly feel slightly out of the loop still on how we were trading on Friday morning. So I just want to keep my answer kind of a little bit more general because I just don't want to lead you wrong. So again, based on the factors that you're telling me, the upside extension, the fact that we know we're in a bearish market, that you have a setup through the inside 15 with the SPYs and Qs that is being confirmed by an extended 15-minute shooting star in the IWM. I like all of that for a short. I just generally don't like the time of day would be the only thing that I would say against it, but I think it's a good trade. I think it's a good trade. Sharir saying, I just heard that we usually don't have more than 7 to 8 2% days this year, and we've already had 35 2% days in the indices reflecting volatility. That's a heck of a statistic. That's a heck of a statistic. And the year's not even over yet. And we're still posting them up, right? Here's another one today. But that just is another statistic that, confirms everything we've been talking about with this year on the volatility, the low liquidity, and, how we need to approach it. So that's great. Brett Snover saying that we have a potential island bottom in the market if this is a breakaway gap. I wish my 15-minute went back far enough, but yeah. Can't really see, it's not in the Qs so much. The IWM, you can see it a little bit. You got the gap here and you got the gap here creating this island of price action. That is a potential kind of island bottom there. And the SPYs, it's distorted by this fake tail I have in my chart that's not real. But we really gapped up to like 372.50. So you got a little bit of a gap here and a little bit of a gap here. So it is. It's potential of an island bottom for the the SPYs and the IWM. Oh, and one other thing I would point out for the bulls out there, the double bottom. This is a double bottom is still intact. I spoke about it last week. Real double bottoms, and I'll tell you, this is exactly what happened in 2015. Real double bottoms, the second low is usually lower than the first low. And it helps the market because it shakes even more people out. And I remember it. I remember it so specifically because I was thinking about this last week because this is part of my own personal development as a trader. I got caught shorting, and obviously I managed my risk, so it wasn't the end of the world. I got caught shorting basically the low of the year in 2015, which was also a double bottom. Let me see how on point my memory is. Maybe it might have been 2016. It was 2016. I'm pretty sure. Let's zoom in. Let's see how good my memory is. I'm getting old. Is this one? What's this low? 181.02, 181.09. We didn't breach it. Man, I could swear I have a memory here where this low breached this low. Did the Qs do it? Qs did it. Qs definitely did it. What did the IWM do? The IWM did it also. And I'm sure some of the stocks I was in did it. But the SPYs did not. The SPYs did not. I remember this double bottom here, this W pattern in here, which is the beginning of 2016, not 2015. Maybe I am starting to lose it. And I remember, I guess it wasn't the SPYs. I shorted something. I think it was on this day through this low for momentum. And it was like, literally, I shorted like 2 cents off the bottom on whatever stock it was. A good double bottom, and it didn't do it for the SPYs, but it did it for the Qs and the IWM back here in 2016. A good double bottom actually gives that second low a little bit lower than the first low. It shakes people out even further, and then kind of gives the upside continuation. And that could be. I'm not calling for this, but we'll see. there is the potential here of this being a wider W type pattern here where we broke this low but didn't get the follow through, we snap back. That's only, it just again shows the volatility. That would only ever be confirmed in the break of this high. So we're a ways away from that. That would only be confirmed on the SPYs getting above 431.73. So yeah, ways away from that. But it is notable how this low broke and didn't give the follow through. In addition to this bear flag failure, this double bottom-ish type pattern is still potentially in play. Next from Denver Steve. In a bear trend like we've been in, taking those trim and trail profits is great. Otherwise, they might disappear. Big lesson from you that I've learned, take a profit. Yeah, for sure. Trim and trail. And again, when I'm talking about being greedy with your positions here, like when I'm talking about with Apple, 25% of your position. You know, keep that 25% of your position. You're in a win-win. See what happens. Look to trail. Raise that stop over time if it gives you the opportunity to do it. Because it doesn't have to happen too much, but that's how you're going to be able to capture the significantly larger reward for the risk that you're actually putting on. From Hemming, I know how to set up the stop orders based on variance. How do you set up the number on two different kinds of stocks? For example, Google and Tesla. I usually do set $1 for Tesla, 50 cents for Google. Yeah, what you're describing, Hemming, is something I don't ever do. I don't ever do that. I don't put stops in based on variance like you're talking about. I don't do stops that are based on a percentage for a stock, or you know, a set dollar amount, like $1 or 50 cents or whatever it is. My stop losses are always based on the chart. I find that when you're choosing those numbers, even if it's not entirely, you know, random because you're doing it based on statistics, I like to use the technicals. I want the supply and demand picture to tell me where the stop loss is supposed to be. So every type of trade that I teach comes with a specific stop loss based on the setup of the trade. That's my definition of what a trade actually is. The definition of a trade is something with a technical reason and a technical out. Out is the term that we use for stop loss. It's technically based. It's based on the chart. That is how I do it. And I can do it for any chart based on that type of thought process without having to have the, you know, statistical data that you're talking about. And sometimes, you know, even, you know, you're saying here $1 for Tesla, 50 cents for Google. Sometimes you can get much less risk and have it be a very appropriate trade for what you're talking about here, or compared to what you're talking about here, that can give you a better risk reward. Or sometimes, you know, the appropriate stop might even be more than what you're talking about. So that's what I do. I, you know, definitely encourage you to, you know, re-review some of my training program classes where I get into that into more detail. Shane saying, interesting to see that the Australians have a smaller than expected rate hike, one of the first pivots by a central bank. Have a game plan. Yeah, have a game plan and it might never get activated is a comment here from Mark. And I love that comment because it's something that you're saying it very succinctly on something that I always try to get across to people like all the time. You know, one of the ways in which I love to view the market is in terms of if-then statements. If this happens, then I expect this, or then I want to do this. So all the time, you know, when I'm kind of presenting the game plan in the morning meeting, it's based on if-then statements. If the stock gets through Paramount, right? Did Paramount ever break through 20? Into the close, maybe? Oh, it did break it. All right. Maybe my stop didn't go off. You know, if Paramount breaks through 20, then I want to consider a breakout trade in it. But if it never gets to 20, then my trade never gets activated. I like that word, activated. I'm going to have to steal that. Have a game plan for all contingencies in the market. It might never get activated. If it never gets activated, no harm, no foul. I love it. I love it. I never actually read PS's full comment on the Fed pausing. basically you're saying if interest rates are still at these levels, aren't the bounces likely to be short-lived? Yeah, we're saying the same thing. The bounces could be short-lived, but they could be violent in nature, and that's what I'm trying to get across with a review of what happened in March and what happened in July and August, and an understanding of liquidity and market dynamics. Geoff saying that today's Fed speaker was more dovish than any speaker the last month or two. I may have missed that, but I wouldn't be surprised to hear it. The entire calendar year, guys, we've been seeing this. Every time the market has a rally, the Fed speakers come out with significantly more hawkish language. Every time the market's getting absolutely destroyed, the Fed speakers come out with more dovish language. We've seen it the entire year. It's part of the Fed trying to walk this very fine line to try to lead to this soft landing, which the soft landing maybe is lower probability now than it was some months ago. I still don't think that it's fully out of the question, but they are really trying to walk a fine line here, and a study of history will show that it is unlikely but not impossible for them to actually do it. Supply chain continues to improve. Yeah, for sure. I mean, this is a lot of the data that I've been talking about with inflation pulling back, and let's see what happens here. I like Rich's comment. As the Honorable Hank Paulson once said, I don't have to use the bazooka if I know I have it in my pocket. Yeah, P.S. I don't know if they have to maintain the numbers that they've kind of forecasted on the rolling off. You're right. If they're going to reach the numbers that they said that they were going to be doing, they probably have to actually sell. But they haven't been, just because they've been rolling off. And they did it to a degree in 2019. And it didn't really slow the market down, right? We reduced the Fed balance sheet by, I think, $1 trillion in 2019. If my memory serves me correctly. And I think that a lot of that was actually in this period, where we had a lot of this sideways price action for that summer in 2019. And I remember we had this, big technical daily breakout through 301, 302 in the SPYs that then led to this, resumption of this crazy upside grind here in the market. Right until everyone recognized that COVID was a thing. From Justin on YouTube, I get 357.03 on the SPY was extended. $357.03, so you're talking about this low. Is today's close on the SPY in your definition of market technical equilibrium? Yes. Yes. So where we close today is in what I would consider to be technical equilibrium. Now there's other factors also that you want to consider. So for me, it's pretty straightforward. We're in technical equilibrium here. I also like to pay attention a little bit just for tactical trading, I guess, and I'm using that word on purpose. That short-term tactical sentiment indicator that Pat's usually able to give to us in his morning note every day. I wouldn't be surprised to see if that's actually cooked to the upside coming into tomorrow, which basically is a signal to me that yes, we are in equilibrium, we're not extended on either direction, but the viciousness of this 2-day move, it's a further piece of information to not buy tomorrow, and it would be a further piece of information where, going back to what I was saying earlier in the meeting, you have a short setup potentially on a gap up tomorrow. We could really be looking, if we can gap up to that 380 area tomorrow, it's certainly a signal to book profit on longs, probably a signal to potentially, put on some shorts, some hedging, things like that as well. I want to pay attention to that data tomorrow. A flat open or down open tomorrow, I think, gives us much less to work with. Scrolling through your comments here. Yeah, sentiment's brutal. Loving the chatter, guys. I totally love it. Sounds like it's mostly back and forth between you guys. Steve here. Yes. So Steve's saying, from the trim, and this has actually been one of the difficulties, I think, of this calendar year, right? So, what we're talking about with those rallies in March, the rally in July and August, or, a potential rally that could come in now of trimming and trailing, the ability to be able to take a lot more size will be massively beneficial on that move to make a lot more money. The problem is, in this environment that's been marked by such high volatility, it makes it more difficult to have larger tier size positions in general. So unfortunately, I think that just makes it even trickier for, maybe smaller accounts who can't have the big tier sizes, because you got to have small sizes to give the right stop loss, because the volatility has been so big. The downside of that is that when we start to go, you don't have enough stock to trim and trail. You either trim or you trail, right? And in that case, I'm going to generally probably advocate more going on the trailing side than the trimming side. So yeah. From Mr. Trees, if you had a 401k that was allocated all into cash equivalent today, how would you work on re-entering the market? So I always like to do things based on data and based on statistics. And even though I'm a trader, I have reviewed a decent amount of data on investing in the past, and what the right thing is to do just based on the data for the average person that's out there. And the data all points to that for the average person that's out there, like the best thing that you can really do is dollar cost averaging in the market, where you are just, whether through your retirement account or whatever, you're just buying a little bit of a set amount every single month. And that has the, that has the benefit of, just increasing your portfolio over time. But also, if the market pulls back, you're happy if the market goes up because you're invested. But you should also be happy if the market goes down because you're able to get more stock in the companies that you believe in or in the market at better prices. So an interesting thing, though, is the statistics on, let's say, and I've heard and read this. Let's say that all of a sudden you just got a big lump sum of cash, like what you're talking about. Either you got a 401k that's been allocated into cash and you just had this bear market, so you're in a good spot, or you get an inheritance, or you won the lotto, or all of a sudden you get a big cash infusion. It's really interesting, the statistics on what to do with that. The statistics show that generally the best thing to do is to take all that cash and throw it all into the market all at once, and then begin dollar cost averaging on future cash. That's what the statistics show is most probable to be the best thing for you. But, and this is a big but, let's say you got that big inheritance or whatever it is, you won the lotto, and you happen to win the lotto on January 1st of this year, and you did what I'm talking about, even though the statistics and the probability throughout history said the best thing is just to put all that to work all at once. Here you are looking at that lump sum of cash, 30%, or potentially maybe more, depending on what stocks you're involved in, actually even lower, right? And then that wasn't that good. So again, the math all shows, or the probability, shows on everything that I've read, that if that happens to you, statistically the best thing to do is just throw it all in at once. But I think that it might make sense to still piece into it. So what I probably would do if I just had a whole bunch of cash and I was an investor, especially if I had a continued stream of income, and again, this is not individualized investment advice for you or anyone else. Refer back to the disclosure that I did at the beginning of the meeting. I don't know anyone's personal circumstances well enough to give them investment advice on what they're doing with their retirement account, as an example. I can only just kind of tell you the statistics. What I probably would do is, knowing that data, I probably would throw 50% of it in all at once, and then I would take the other 50% and divide it over 12, and put in that same amount over at the beginning of each month to kind of dollar cost average in the market. I am not a believer in actively trading your retirement account. I would say that also. I think that your retirement account is something that you should be extremely conservative with. I know a lot of people trade their retirement account. I know personally a lot of people who do actively trade their retirement account. Perhaps some of you guys here in the VTF are actively trading your retirement account. Do what you're going to do. I'll talk about myself personally. I have an active trading account through T3. I do all of my active trading through T3. And outside of that, I have accounts that are basically going to be all for retirement. I do not try to time the market on them. I do not try to trade them technically. I literally just dollar cost average into the market on the other accounts that I have. And I save all of my trading for one particular specific trading account. So that way, I don't know. I don't know. I'm not planning on blowing my account up anytime soon, but I at least always have this dollar cost averaging safety net for myself. So that's how I do it. Justin giving me a compliment. I appreciate it, Justin. From Rich, if you've got a bazooka and people know you've got it, you may not have to take it out. That's the exact quote from September 8th, 2008. All right, gang, so it's 5:20 here. I think I got through all the questions. So I'll call it. Did I miss a question on the YouTube from... I actually have the YouTube up on the same time. At the same time, I don't usually do that. What is going on with these best adult dating site spam in here? I'm kind of low on time. I'm going to have to jump here. Looking for shorts around 9 to 5 when the SPY was extended and the big volume bar was reasonable. I wasn't, Sebastian. I was more focused on just profit taking and recognizing the fact that this is a potential breakaway gap to the upside. Thoughts on oil news that hit today? Are you referring to... I thought that was out yesterday about how OPEC might cut. I'm not sure if I missed anything new outside of that. But yeah, we saw a little bit of strength on oil come in. All right, gang, I got to wrap things up. Have a fantastic night, everybody. I'll see you all tomorrow.